Welcome to CPE Voices, our series through which we present insightful discussions among industry thought leaders, moderated by our editorial team. During today's outlook for 2023, we'll be addressing key questions as we head into the new year amid a shifting economy. Before we begin, I'd like to thank Oracle NetSuite Allied Cloud for sponsoring today's program. I'm Suzanne Silverman, Editorial Director of Commercial Property Executive, and I'm here today with 5 of the industry's leading executives, individuals who probably need no introduction, so I'll keep it short. They include Camille Renshaw, co-founder and CEO of B&E, Hessam Nadji, President and CEO of Marcus & Millichap, Chuck Schreiber, Chairman, President, and co-founder of KBS, Jonathan Martin, CEO North America of AEW Capital Management, and John Gates, CEO Americas Markets for JLL. We are recording this session and it will be available for later viewing. In addition, we're going to leave some time at the end to answer your questions, but please feel free to submit them at any time during the webinar. And thank you to those of you who submitted some in advance. We'll try to get to as many as possible. Let's start with the elephant in the room. Last week's pullback on inflation and the resultant market rally. What were your feelings about the improvement? Did you agree with the response? Hessam, let's start with you. I think you're on mute.
Sorry about that. Is the audio coming through now?
It is.
Good morning. Thanks for having me on the program, Suzanne. Great to be with everyone. Last week's news was obviously welcome, and it really shows the lag effect of the Fed's actions. In retrospect, it's really unfortunate that a year ago in 2021, the lag effect wasn't really considered as part of the strategy as much as it should have been, in our opinion. And now we're seeing inflation start to peak and the trend's moving in the right direction. It's only 1 month's data. It's not a trend just yet. And we have a lot of distance between where we are today and where the Fed wants to see inflation. So there's more work ahead. But the news was encouraging. You saw interest rates coming in a little bit. And of course, the enthusiasm in the stock market was maybe a little bit overdone. So it's the movement in the right direction. I don't think it's a trend just yet. And it's a foreteller of what will happen when we get real evidence that the inflation wave has topped out. There's a lot of capital on the sideline. People are eager to get back in the market. And of course, there's a valuation disconnect right now because of interest rates. And a lot of capital on the sideline waiting for this additional good news to come on the interest rate front. The bigger question is, how much damage has the interest rate, successive interest rate moves done to the economy that's not visible yet? Again, the lag factor means that the effects of the increases aren't going to show up for another 6 to 9 months. And my concern is that in April, May of next year, we're really going to see the job losses that the Fed is actually looking for in order to alleviate wage pressure. So that's the other cloud of uncertainty in terms of the effects of these interest rate increases on the economy.
So Hessam touched on how far things will go next year, as well as the employment market. Let's look a little more at the overall view for next year first. John, could you maybe comment first on how much of a shift you anticipate in the CRE industry's performance next year due to the economic downturn, and what your biggest concerns are?
Sure. I think the shift next year in performance of commercial real estate is going to be relatively significant. The public markets here adjusted in 2022 pretty quickly to the rising interest rates, as Hessam was mentioning, and the private markets really haven't adjusted yet. You saw a small adjustment last quarter as values began to move. But I think at this point, everyone in the market has kind of realized that the increase in rates isn't temporary. It is something that's probably here to stay, and that assets are going to have to reprice in this higher yield environment. So what does that mean? I think we could probably look to the GFC for a little bit of guidance on what we might expect next year and the year after, maybe not in terms of scale, but at least in terms of timing. And so we saw the first write-downs in the GFC occur in sort of the second quarter of 2008, and they took about 8 quarters to run through, ending in early 2010. And those first couple quarters were smaller adjustments, right? That sort of like what we saw last quarter. And then they rapidly picked up before tailing off sort of towards the end of 2009 and then 2010. And I think that's probably what's in the cards for us for 2023 and 2024. Again, the scale is something that will be determined as we go forward. What's my biggest concern? I think right now my biggest concern as I look at our businesses, what's the timing and consistency of that, right? Like, so there's a lot of, I don't envy appraisers right now, like trying to figure out what market value is and, assigning prices in a market that's sort of in stasis right now. So how those valuation adjustments get recorded over the coming quarters is going to be interesting. And I think it's going to vary some by investor to investor. So that's something that bears watching.
Anybody else have something they'd like to add on to that?
Well, I think you're hearing an echoing of timing. None of us have crystal balls, and our clients don't either, in terms of timing. And the various levers that are being pulled by the Fed and otherwise are going to influence where rates go, where pricing goes, but we just really don't know at what speed. Have we peaked out? I think most of us agree probably not yet. But what will it ultimately look like, and what is the timing of that?
Yeah, public securities reprice very quickly, obviously, and then private assets lag that for some very good reasons. And I agree with Camille's comments that it kind of goes back to what Hessam was saying is we're trying to get a forward-looking view. Most business people, I think, would say that the initial Fed feedback that inflation is transitory was maybe a little bit hopeful thinking. And we would have voted to start earlier. We don't have a vote at the Federal Reserve. And so, but it is good that the Fed's reacted aggressively, I think, in my view, because inflation, it's the most we've seen in 40 years. So that just affects how you think about pricing for anything. When interest rates go up, if you think of forward-looking asset values, the discounting on future cash flows is just more severe, is kind of what happens. And if you look at the REIT market, as John has said, sometimes they trade like stocks and sometimes it trades like individual real estate assets. Suddenly they're trading more like stocks or securities than real estate assets, but over time that'll kind of reset and I think level out. The question is how much downward pressure should there be in the short term until we have a clearer picture of our path as an economy going forward.
So Chuck, what are you hearing from clients now?
Well, we could really have, maybe to use that word, we got a couple different clients. Our portfolio is about 20 million square feet of high quality office space around the country. And we view our tenants as clients. And so, the tenants have really put off making decisions for their space for almost 3 years now. But consistently, they want their employees back in their space. And so, what's really has transpired is because they've delayed making decisions as far as their office space, we have an urgency from a number of tenants who are coming in that need to change their space. So they're coming to us asking us, how can we help them recreate their space so that their employees would be happy to come back into their office. And so there's a real concern about long-term demand from their employees. But there's really a desire to get everybody back in the buildings. As far as our investors, most of our investors are high quality or public pension funds or individual investors, and they're long-term investors, and their focus is really cash yield. So we've dropped really in the last year, we dropped our occupancy a little over 1%, 100 basis points, which is significant when you've got a portfolio as large as ours. But we're fortunate that we have consistent demand in our buildings from tenants. Lease rates haven't varied very much in the offices where we have space, in the office market rather, where we have space. And so what we're really focused on is really that cash yield, to consistently be delivering that cash distribution to our investors as they're able to make decisions over the next 12 to 24 months, really how to balance their portfolio really to emphasize their future investments as they need it.
Yeah, to a certain extent, Chuck, one weighs on the other, right? When you think of tenants and then the folks who own the assets. And in times of uncertainty, everyone slows down their decision making. We do it as individuals too, or households. Maybe I won't buy that car right now. We'll hold off. Well, businesses are the same way. Maybe I won't make a decision this soon, and I'll see if we have a better picture here in a month or so. And a month can become 3 months pretty quickly. And if you own real estate assets, you're waiting to see what if interest rates turn back the other way, or tenants do start to make decisions again. It just slows everything down.
You know, one thing that I've heard recently is the anticipation of a Fed pivot to actually lowering interest rates, in that, you know, by the time the job market really does start to turn south and the layoffs that we're hearing about accelerate, it's going to be so bad that the Fed will have to lower interest rates. We're advising our clients to be very careful banking on that kind of a speculative expectation. So the inflation does take time to wring out of the system. The Fed has already stated that they're going to stay as aggressive as they need to in order to fight inflation. And given the fact that the interest rates are going from 0 to 4, 4.5, 5, you pick a number on the federal funds rate, which is pretty much in line with long-term averages for the past 20 years. I don't see a scenario, at least in the near term, meaning the next 12 months, where rates are being lowered again and there is another round of stimulus or anything, unless, God forbid, something really terrible happens, which nobody wants. So that's the one thing that I think is important for the industry to start to adjust to. I think John said it is, we need to come to terms with the fact that normalized interest rates are here to stay. And they've been a part of the business for so long that it shouldn't be a surprise to anybody, but the shock of going from near 0 to 4.5 or 5 is what's really disrupting the market right now.
But the thing is, whether you're an operator or a tenant, or whether you own real estate, you go back even a year ago, no one was underwriting this rapid an increase in cost of capital.
Right.
So you suddenly, whatever assumptions we had made about a tenant, about a business, or a property, things are pretty different all of a sudden.
I think especially if you were trying to make a deal in the spring, right? We get a lot of questions in the net lease space about why cap rates haven't moved too much yet. And so much of it is, if you think about the life cycle of a typical deal, and it's 6 months, and this goes into sort of all of our assets, but especially for net lease, a lot of that money starts with a 1031 exchange. That seller probably, when they go to relinquish, can't get out of their exit plan. Their exit plan is still a 1031 exchange. They have 45 days in the middle of all these changes in which to make decisions, choose assets. They're still closing on those right now. Not all of them, but many of them. And that has kept such price pressure and compression on the market that I think it's going to be interesting when folks don't have to make decisions next year, and they can be more strategic and long-term what that pricing looks like.
I think going back to talking about, starting to see performance decline next year, that actually will be a good thing to some extent, in that I think most of the clients that we're talking to that have capital to invest are waiting for those adjustments to take place. So everybody's sort of sitting on the sidelines, and it'll, as we start to see values adjust, I think that will definitely bring, a little more liquidity to the market.
So with all of that said, what are your priorities as we head into the new year, and how have you changed them to prepare for these coming changes? And Camille, why don't we start with you?
Well, B&E is a net lease firm, so a lot of our clients or principals own assets long-term with long-term lease terms, and they don't have to deal directly with the property taxes, property insurance, or things that a lot of the other folks here are dealing with. So a lot of what we're doing is sitting down and advising the client and just really digging hard into relationships. I would say probably all of us are doing that. That's an old school trick, right? Like, now is really when your clients need you. They want to talk to you. They want real advisory from you. A lot of what we do in net lease, though, is advise folks to not do anything sometimes, which is very tough advice to give when you're a transactional organization. But I think we need to, in the coming months, just sit down with client after client and advise in a block and tackling kind of way what to do with their portfolios and what execution is best, especially as Hessam said, that interest rates could, peak at some point, go back the other way. If you have the ability to hold for several years and you are in a situation where you have rent escalations, you're not going to be impacted negatively by expenses, you should be very slow to move. I think it's probably worth adding as well. One thing that I look back on, John mentioned the GFC. One thing I think about is RCA data that went back to 2007, 2008, 2009, and as the market just froze because nobody kind of knew what to do and transaction volumes dropped, volumes actually against that trend and net lease spiked. And a lot of it is because folks from other asset classes that don't know what to do move into net lease at this time, sort of like bonds against stocks, in the traditional way. Sometimes shorter term bonds, sometimes longer term bonds, depending on what your play is and your particular prospectus. But it is a very safe place for capital. So it's when I say, not doing anything, you may have a lot of movement as you seek security through this cycle.
Okay. And Hessam, let's talk a little bit more about the survival tips that you've learned from navigating past downturns. That's certainly interesting, and you've all had plenty of experience to draw from. How are you positioning your company to persevere through this cycle?
Well, Camille really articulated it well in that we're in a similar business, of course, as well as JLL. It's all about client relationships. You are there when times are good. You're there during uncertainty. That's why we invest so much on research and content as a way of helping clients navigate. And that navigation becomes so much more important when there is disruption and a lot of uncertainty. We kind of pride ourselves in being problem solvers. A lot of our clients have other reasons to sell than simply the macroeconomic factors. We do dominate the private client industry. We have a very active institutional division, of course, as well. And their motivations are completely different, and their decision-making process are almost entirely different. So private capital, being much more entrepreneurial, actually can act at a time of uncertainty, more quickly than institutions can, because of the fact that they have more flexibility, or they have personal drivers that lead to that 1031 exchange, or the motivation to have to raise liquidity from a real estate asset due to other life circumstances. And our job is to really be in touch with them all the time and help them navigate both current assets, investment opportunity, refinancing. One of the things that our mortgage brokerage department, finance department has become so good at is finding lenders that will step in when other lenders are stepping out. We did finance transactions with over 400 different lenders in the last 12 months. And that gives us a lot of different flexibility to solve a problem for a client if one lender is out of the market, but another one may be interested, with whatever the terms are, to finance the deal. So we have an offensive strategy, which is all about client outreach, client contact, continuing to recruit and attract talent and acquire complementary firms. And the defensive strategies, which I'm sure for all of us includes looking at expenses, looking at non-essential investments versus really critical investments, and prioritizing. It's amazing how fast this disruption came. We anticipated it, we had factored it in, but we had also counted on much more of a smooth rate increase process and not such a shocking, slope. And so when it happens, you just have to pivot and have to react.
I think I was with a group yesterday. If you just reflect on the other downturns, because we've all been around for a little while, they tend to happen faster than anyone anticipates. Some, and I think our industry is good at underwriting risk. It's part of what you do every day. And so we probably coming out, and I don't think we're coming out yet, by the way, but you underwrite more risk than once the risk starts to go away, maybe we don't see it as quickly as it does.
Sure.
But in any event, to your point, you run to your clients and understand their individual circumstances and find ways to transact if they need to. Totally agree. The largest commercial banks are, and we'll say they're out of the market, but you're going to get something done with a regional bank probably today, and you're not with one of the largest banks. But just be a really good advisor and understand their individual circumstances, what they need to accomplish, and help them think through that. And it's different for us. We've got a very large subset of investor clients that have often analogous challenges. Occupiers, it's all over the map and helping them understand what they should do. But ultimately, when you start to see value, it probably really is value, and it's probably a good sign, and that's a good time to jump back in.
Right.
I would say, I'm sure Chuck would probably agree, as asset owners too, what the tips that you're looking at now are being very proactive, right? You're looking at all of your assets. You're trying to look into the future. You're looking at capital structures. You're making sure you have adequate reserves. And to the extent you have issues, you're making sure you're jumping in front of those really early, talking to your lenders, talking to your investors, and trying to keep things, in order, right? It's all about managing risk and not being caught by surprise, right? And being, ready for, as John was just saying, what you might not be projecting, right? Nobody thinks it's going to move this fast or that slow or whatever. And it's trying to just look at all scenarios and make sure you're prepared.
So let's look a little bit at the tenant side and the occupier side and the leasing market. And I think, John, you were just saying it's a little bit all over the place. And I know when we were talking during our planning meeting, you were pointing out that it's the same with labor also. We're starting to see some layoffs, both in the real estate industry and among certain types of tenants, certainly some of those technology tenants that are all over the news. But speaking broadly of the employment market, how do you see that shaking out? And does the labor shortage go away through this? Are there types of employees that are needed that will necessitate continued hiring or hiring in specific industries, and some of that might support continued strength or even growth in certain industries?
It could be. So that's one of the things that's very different right now, right? Is the labor market. Typically in a downturn, you have a fairly rapid erosion of jobs. We have been in an environment where there's been a shortage of labor in the two broad categories called office workers and non-office workers. Maybe in the old days you said white collar and blue collar. The last downturn, the pandemic, everything was different. No one had been through that, but we've been through inflationary driven corrections before. Typically though, unemployment starts to tick up pretty rapidly. And we haven't seen that. To your point, you're just starting to see it with office workers. You've seen quite a number of announcements. Technology tends to be the most, it's the highest beta industry probably in our economy. So it moves very quickly up and it moves very quickly down. So large tech platforms have announced, job erosion, and they're in the thousands when they make those announcements. So they're big companies. If you look at the underlying data though, in our overall workforce, we've actually had a declining nominal number of people that are non-college educated workers in this country for the last couple of years. And on the other side, actually, the nominal number of college educated workers in the United States has actually been increasing the last couple of years. And I bet you most folks would get that ratio backwards. What we see now is we see an erosion in office working jobs. And you'll start to see it in non-office working jobs in certain sectors. So if you're a single family home builder or you build apartments, at best you're going to build probably half as many units next year as you thought you were a few months ago, right? And so that will create a job erosion. The question is there growth in the economy that would backfill those jobs, especially if the nominal number of workers is declining? We have a lot of stimulus that's going to come out over a long period of time, but it's around sustainability and other things like that. So you'll create new non-office working jobs in those spaces, probably to backfill it. So in the relative near term, let's say the next 6 months or so, we'll see a loosening of office workers, and that pressure will go away, I think, and you'll have some uptick in unemployment. I just think there'll be a longer lag on the non-office workers, and so that'll continue to create a little upward cost pressure in those spaces for a while. So that makes it a little harder. Net though, what the Fed is doing is going to work. It's just a question of how long it's going to take.
I agree with John. It's going to be interesting to watch a little too, a lot of those non-office workers because of things like declining immigration, the aging of our population, the sort of decline in just the overall workforce. And you look at the total number of open positions today versus the available number of workers, that's going to make that decline in employment maybe a little, take a little longer than it has in the past. And that probably has some repercussions for how quickly the Fed starts to be able to back off on, raising interest rates. It's going to be very interesting to watch.
And that part of our economy, it's always interesting to see how quickly things can shift. If you go back enough decades, manufacturing in the Midwestern part of the United States started to really decline. Well, that involved labor moving to different parts of the country. And then energy starts to really take off, and you saw rapid job creation there, and then that shrinks. And then we have the driving economy and deliveries so how quickly those pools of labor shift to a new opportunity is really an important thing to watch, because we'll see new opportunities created here for a lot of reasons, even when it's diminishing in others. If you're a tech worker, you might be on the sidelines until they start hiring again. That's a different phenomenon.
Joan, looking at leasing performance overall, what's your expectation for next year?
Well, I think if we just break it into the three biggest asset categories for leasing and leave multi out as a commercial category for now, I think you'll see a further erosion of leasing in the office markets. And of course, that's the asset class where we've still been working our way through recovery post the pandemic. What type of occupancy levels are we going to have? Are we going to use buildings sort of in the same fashion? And I think Chuck talked about that earlier. And so that's still working its way through, but now in a time of uncertainty, hiring is going to go the other way, and you'll have job losses, and corporates make decisions kind of as slowly as they can, is my experience in this environment. So if I have to make a decision because I have a lease that's expiring and I have no intention of not having a lease in that market, then I'm going to sign a renewal probably, but I'll sign a 3-year renewal if I can, as opposed to thinking about shiny new 10-year space. That clashes right now with the different occupancy environment that, again, Chuck described earlier on. Tenants need new ways to entice people and get them excited about coming back. So, but in the office sector, clearly volumes will fall further. They were maybe at 65% of pre-pandemic levels, just in terms of leasing volume. So maybe that gets to 50%. I don't know. Industrial's been on such a growth trajectory that maybe that flattens to very low growth year over year, or maybe even a slight decline. I mean, right now, construction financing is directionally, it's really, really expensive if you're going to do it. So construction's going to kind of halt for industrial product for some period of time. Maybe it's 6 months. That'll tamp down industrial leasing a little bit next year too, because it'll be the slack of product, because occupancy levels are very, very high. And then finally, retail activity we see is still quite solid. If you talk to retailers, consumers are still spending. They're shifting where they're buying, but the retailers we talk to would still like to continue to expand their footprint and roll out. Cost is the major sort of mitigating factor right now. We've seen such a rapid run up in construction costs that has to impact the net rents that they're paying. And at some point you get to where they say, "Uncle, I can't afford that. How do we work this out?" But retail leasing, I could see actually increasing next year, year over year, because consumer balance sheets are still quite healthy, and they still need to shop and for basics. So that it's really three different segments that will react differently and individually.
I would actually jump in and add one thing. In addition to my work at B&E, I'm an investor in several startups, and just coincidentally this morning, one of them, Blace.com, like blank place, BLACE. It's an event marketplace. We had a board meeting this morning, and one of the things they're predicting for 2023 is an increase in events. And it's just a converse effect of fewer people coming into the office, that employers want to hold more events to get their employees together. Employees will show up for an event. So it is fascinating how all these things work together.
Yeah, it is. Camille, going back to the retail discussion in particular that John was just referencing, do you see the credit levels of the companies holding up? How do you see that impacting the net lease market?
I would say our investors are definitely watching that. The reason most of you know what B plus E is because we have so much data and such a tech infrastructure to what we do. So we spend a lot of time underwriting these credits and tracking them. There are a number, and this is not a retail tenant, but I always find humorous. We sold an inordinate amount of toilet paper manufacturers last year and the year before. Like, I've never seen anything like it. And these were not credit deals, but they were very popular deals. And their books, of course, revenues had spiked, and really bounced as a result of the pandemic. Now, looking at those books, things are a little bit different. So just trying to find out what are the durable trends folks love in terms of retail, things like double drive-throughs in the QSR space. Is that a durable trend? We think it is. We see folks like the head of real estate at Walgreens talking about how does he emulate going forward more of a Starbucks model where you've got 3,500 square feet in a drive-through. I think in the age of Google Maps, so many of these retailers are realizing that their destinations, they don't have to be on a hard corner in order to capture interest. You're going to look up Walgreens or whoever in your Google Maps app and find out where it is. When conversely, again, a QSR, if it was Popeyes or McDonald's, you may not know what you want until you see it, right? So that hard corner really matters. We're following all those trends in terms of who's growing where, and I would say most of them are fairly stable at the time. But I think it's a really worthwhile question, and we will watch because they're working through a lot of this labor stuff that's primary for a lot of these retailers, and that will impact their bottom line. That's the place that we've seen things move the most is just cost of labor.
In that niche, one thing to add is that there's so much discussion going around the changing nature of the demand side, but also you have to recognize the pullback in new construction. Part of the reason retail in general is really the comeback kid of the industry post-pandemic is the lack of new construction and the reduction of obsolete space at an accelerating pace. Nowhere is that more visible than the single tenant net lease arena, where there used to be so much more development, in the early 2000s, mid 2000s, and that has pulled back significantly, allowing, sort of the market to catch up. And that's another big factor that we're seeing.
And on that note, let's shift into talking about the capital markets. Just a reminder to everybody, please do submit your questions. We've had a couple coming in and we will be addressing audience questions shortly. But let's talk about the capital markets. We've touched on it a little bit, but overall, Chuck, why don't I ask you first, how has the real estate investment market responded to interest rate hikes and economic prospects so far?
Well, Suzanne, I think the biggest concern is the availability of debt. Obviously, debt's more expensive, but today to finance an acquisition of an office building above a $60, $80, $100 million transaction is extremely difficult. If there's a long-term relationship with a major lender, it's very, very difficult to finance those. So really the transactions we're seeing are smaller transactions with regional lenders. So I mean, I go back to years, I've been doing this a while, so I go back to different times over the last 40 years, and really KBS for 30 years where we actually had times where you couldn't finance a building. And I think that is really having the impact, is really the availability of debt. It just drops the transactions. It's just that there are a number of institutional investors who anticipated selling assets during the fourth quarter of this year, first quarter of next year, or even going into the second quarter of next year, who've got to put those plans on hold. And so whether they're dealing with their investors who are anticipating receiving their invested equity and gain back into their coffers, or whether they're going to modify or rebalance their portfolio, that's really a challenge. And because of that debt, because that question mark about really the ability to finance new acquisitions, it really limits the amount of transactions to buyers who are all cash buyers. I mean, and they're basically rare. I mean, we have, one of three of our largest investors is a pension fund. And when I started doing business with them in 1995, they were actually the mortgage department. They invested in debt. So fortunately, their view is if there's an acquisition available and the only debt's available at 6.5%, 7%, they'll take that position. They'll go ahead and they'll structure it being their own lender. So just the inability to finance is really the challenge. And then the impact on values today, where we've gotten our portfolios here at the year end, we're appraising the portfolios, where we're getting consistently a 5, 6, 8, 10% decline in value. It was mentioned earlier, I think John might have mentioned how difficult it is for these appraisers to come in and run an analysis, when there really is not any transaction closing. I mean,
That's
there's
right.
a building that might have been a $150 million building a year ago, and today, there may be 2 or 3 prospects who will even look at that opportunity for a high quality building, and those offers are coming in 15%, maybe 20% below the target. So I think that's just a huge impact on our market. And I'm an optimist, but I think we're going to go through a number of months and quarters where we're going to be facing these challenges.
It'll take a while. I mean, I agree with Chuck. I might say a little differently. The cost in terms of debt give the appearance of a lack of debt, and then the reset in values. Sellers can't be sellers anymore, and buyers can't figure out the numbers anyway because of the cost in terms of debt. So you just see a dramatic fall off in volumes.
I think the added complexity now with the debt story too, versus what it was in the GFC, is during the GFC, you could see the Fed coming to the rescue, lowering rates. You could sort of underwrite, some improvement in the future. And right now the Fed is raising rates, which is moving us in towards recession. So it's hard to underwrite, improvement in performance in the next few years. You're worried about what an economic slowdown might do too. So that's definitely having an impact on the availability of credit.
And at that time though too, Jonathan, we were worried about a crash and widespread foreclosures, that if you lived here, I live in Dallas, Texas, you went back to the late 80s where it was just a disaster, right? And the Fed steps in with so much liquidity to keep that from happening. I don't think we're going to see widespread foreclosures. You get a little relief on capital reserves in the banking industry, and then you'll see more note sales than you will foreclosures. I think we're already starting to see that and taking out, whether it's individual loans or portfolios. But it gives the broader economy, I think, a more comfortable feeling if they're looking and observing our industry and what's happening. It sure appears far more orderly than things we've seen in historical cycles. And I would agree that it is, by the way. It's much more stable, far more stable.
Well, the one thing I'll add is the opportunity, everything that everyone covered is creating for the private cash-rich buyer. And they are very eager to see the effect on valuations of the market freezing to some extent, especially on the higher price points. And there is no shortage of capital on the private client side of the equation that we're tracking that is very eager to buy assets, at the reasonable discount level to interest rates. But if they don't even catch the very bottom, there's so much interest in certain assets, certain markets on a longer term basis, that whether it's a very low leverage or short-term, some kind of a bridge finance solution, or all cash. We are already seeing a huge appetite among our private clients to take advantage of the disruption in the marketplace by being entrepreneurial.
So do you see the pace of those investments picking up next year?
It's
maybe the
already
year
starting
after?
to happen, and it will pick up more as the lag effect starts to show up in the numbers. It's not going to make up for the overall volume decline that John was talking about. I agree with that 100%. The market is just at a dislocation right now. But for us, being plugged into that private capital sourcing becomes one of the ways that we solve problems for those sellers that really do need to sell or raise equity, and maybe even just recapitalize some of the transactions that normally they would have sold, but can't really sell in this market.
Just creates a really wide spread between bid and ask. If you ask sellers what they think cap rate should be, you'll get a really different answer than if you ask the whole group of buyers what they think they should be. So
it's a great discussion when we're talking about taking new listings, and the broker value, opinion of value, and the seller's expectation. is something that we're all living with.
It's a tough question to ask right now about cap rates. Very much a perspective question.
But if I agree with Hessam, if you look at his firm and mine, we're doing a lot of BOVs, and then an asset owner is taking that and saying, am I stuck or not? And it just, so that's a process that plays itself out over time. And it also begs the question that we've talked about this whole conversation is, how long are we going to be in an environment of what feels like very elevated interest rates? And when would they start to turn back? Because those dynamics start to change pretty quickly then. It's just.
I would also say there's some dominoes here on the screen in terms of property types, right? It's not as simple as certainly labor and other factors impact real estate, but I would say our own segments impact each other. And in net lease, and most of you could speak to this, we watch multifamily, right? To see what level of 1031 exchanges will we have next year. And one of the largest apartment teams in the country was sharing with us anecdotally that they've continued to have 25 bidders for most sellable, desirable multifamily assets. They've had 25 buyers, but the pin has never been so far. You know, normally when a seller has, you know, out of reach or unreasonable desires for pricing, still some bottom feeders will show up, but it's a much smaller group, but it's, you know, 3 or 4. But today there is so much capital, as many of you are saying on the sidelines, that you're still getting 25 interested parties. Now, what we are hearing will happen is on multifamily, a lot of these projects were originally written to have a 30% IRR exit. Last year, that started looking like 80%, you know, something insane. And so everybody's having to go back and do new BOVs and restructure or recommunicate to their shareholders what expectations to have. And we anticipate a lot of those assets, those multifamily assets, will still trade, and it'll still be a very healthy return for those investors. And then that capital will go into net lease, which creates more and more opportunity and kind of keeps the pressure on the demand side. I'm sure you guys could all speak similarly, especially as you know, some of the folks who perhaps are just getting out of office, you know, where they're wanting to invest their money now. I think many of the investors were sort of, before this cycle, unable to get into industrial, which is where a lot of those office investors wanted to shift interest. And, you know, I'll let Chuck and Jonathan speak to their groups and their interests, but now with this change, perhaps returns are going to get more reasonable for you guys. Cap rates won't be quite so compressed in the industrial arena.
I would agree with that. It's not a bad thing that there's a return on capital, which is not something that, you know, we've had for the last couple of years, given how low interest rates have been, and it'll actually create opportunity.
Are there any other opportunities you see emerging out of the downturn? Especially any particular niches, maybe niche property types.
It was mentioned earlier that you know the different strategies, complete different strategies may be available. We are seeing pressure on lenders where they're having loans maturing and the borrowers aren't able to refinance. And so, as commented earlier, those lenders, you know, are receptive to having a discussion about selling that debt. And these aren't bad borrowers they have properties which are just in challenges. And those challenges may be where there's a $155 million building, you know, with a you know, $70 million loan that's maturing in the middle of next year. And all of a sudden that building's coming in at $120 million. That lender is not inclined to renew that loan. You know, and that borrower needs to come up with $10, $15 million, maybe more, to refinance that asset. Well, that lender doesn't want to be part of that discussion. That lender doesn't want to expand their real estate department. So there are going to be those transactions available, and it may be a great building. It's just they're having a disconnect with the valuation, and the lender at one time might have been comfortable with a 70% loan, now wants a 55% loan, or maybe be completely out of the market for office space.
Yeah, 100% agree.
I think that debt component is going to be something that is going to be a prudent institutional type of investment, not not some raid on troubled assets, but really a sophisticated analysis to really stabilize that investment.
We're also seeing, and this is a little bit more niche, but it's something that is I'm very mindful of day to day in our net lease dealings, is the zero cash flow deals have been sucked out of the market. And it really does have to do with what you're saying, Chuck. Some of the LTVs that if you're coming out, sold 100 million, you're trying to do a 1031 exchange, you're coming out with a 70% LTV. It's going to be very difficult to replace that if you can't blend a zero cash flow deal or just do a zero to exit. And there are almost literally none in the market, which has never occurred in my lifetime.
So let's turn now to some questions from the audience. And we did have somebody send in a few questions. I guess I will start with I think piggybacking on what you were just talking about, but looking ahead with the prediction is, what is your peak 10-year treasury rate? What's your prediction? If anybody wants to
Who wants to
tackle
go
that.
first on that one?
Oh,
You know,
boy.
when I was in college, we had this great economist lecture series, and somebody asked Milton Friedman, who was a great economist, what will happen with interest rates in the future, and he said they'll fluctuate. Next question. So if any of us were good enough to tell you the exact date, Suzanne, when 10 years we're going to peak, we'd be out there making a whole lot of money. Sometime in the next 6 months, probably to 9.
Yeah, I think it's above 5. I think maybe above 5.5.
Okay,
Agreed.
so piggybacking off of that, somebody else wants to know, in underwriting, what assumptions are being made for rent growth 3 to 5 years out? And I guess that's property type specific.
Yeah, I was going to say it varies very much by property type, but maybe the general trend is down. Obviously, just looking ahead at what's going on, right? Like, so the capital markets have moved very significantly, like rates are up, but the economy's held up thus far, and property fundamentals have held up thus far. And we've continued to see good rent growth in, across sectors like multifamily and industrial. But I think everyone's looking forward now and realizing that we are moving, if not already, moving into recession, and you're going to see a slowdown in demand. So I think in general, you're seeing more conservative underwriting assumptions today, right? And I think through the first half of this year, we continue to see transactions clear. You could look at a deal, you might know that the interest rates are up, you might know that your cost of debt, you're sort of a negative leverage. But if you could underwrite to using your assumptions to getting to positive leverage in 2 to 3 years, those deals were probably getting done. And there's definitely been a shift in that. And now you need to effectively be a positive leverage sort of day one for a transaction to close. And that's a pretty big shift.
If I was trying to look 2 to 3 years out, I would sort of look back to 18, 19 levels, where you had more moderate rental rate growth. That's probably where we return in asset classes. The near-term anomaly that we see, Chuck was kind of describing earlier, the phenomenon where tenants need to rethink their space and the environment, and the return to the office is a major part of that, right? So where office transactions tend to be happening are a much newer product. And we see a lot of peak net rent deals being done, believe it or not, in the office sector right now in a lot of markets. The overall volume of leases happening is off materially, but there's some expensive things getting done because got to be a new building, got to be highly amenitized, has to be a good location, street level activation, and all those things are more expensive to deliver. So that's a near-term anomaly, but I would probably say downward pressure across the board beyond that.
There are offices.
I'm sorry, go ahead.
Sorry, go ahead.
No, you first.
Our portfolio, as I mentioned earlier, is high quality office and also multifamily. And the high quality office varies drastically around the country. In the Southeast, we're stable, maybe even continue to grow market rent growth. In Northern Virginia, where there's so many governmental tenants, our leasing activity is nil. So we're already off 5%, 7%, 8% of market rents. In areas in Texas is solid. We're seeing market rent growth in those markets, and in Salt Lake City area, we're seeing market rent growth. And up in the Seattle area, even though there hasn't been much office development on the east side of Seattle, because of the amount of sublease space that's coming in the market. It has just really damaged the market greatly. And so I wouldn't be surprised if over the next 3 years we see a up to 10% drop in market rent. But those are tech tenants, so they may be putting it out maybe hundreds of thousands of square feet of space for sublease, but they can absorb 200, 300,000 square feet over a region in a very, very short period of time.
Yeah, I bet you the most likely tenant for a lot of that sublease space is the tenant that's putting it on the market. It's just going to be a year or so out, right?
Right. I think multifamily is going to continue to grow. The fact that it's very, very difficult now to develop multifamily space. There's consistent demand, but the cost of debt is really making a burden that very, very limit that first-time buyer. Unfortunately, that first-time buyer, is really out of the market, unfortunately. So they're going to remain being tenants in multifamily space. So in the space that we're involved in, we're optimistic that we're going to continue to see 2, 3, 4, 5% growth in market rent for multifamily.
What I was going to jump in with is on the interest rate forecasting. I'm a little bit more optimistic that we top out somewhere between 4.7 to 5% on the 10-year Treasury over the next 6 months or so, because I'm a big believer in that. The 4 successive 75 basis point rate hikes are going to deliver a lot of slowdown to the economy in the next 3 to 9 months. And that will start to turn the employment market toward job losses. We're adding 300,000 to 400,000 jobs. The Fed wants to see us lose 300,000 to 400,000 jobs. And I think with those successive torpedoes that have been launched against the economy, that will start to happen, which will ease the pressure even further on inflation. And the Fed won't have to really go to even the next level of extremism to at least get the trend down meaningfully toward their target. Now, I think their target of 2% on the PCE is probably unrealistic. And I think that probably has to fundamentally get adjusted up to a new world, to a much more normalized world. And I think the supply chain issues are likely to get better, not worse, assuming no other global disaster happens. And put on top of that, hopefully resolution to the war in Europe at some point, one way or another. So those are all factors that are out there that haven't come to fruition yet, that I think will take the pressure off of the 10-year having to be above 5 for a meaningful period. Now, where will it settle, and where should we expect normal to be? It's not going to be 3, and it's not going to be 3.5. So this is where the industry just has to adjust to with a 4.5 on the 10-year Treasury being normal again, and that was considered a low interest rate not too long ago. And so it's this adjustment that's creating a lot of havoc for all of our clients and all of us. And then lastly, and I think this is an important factor to think about, it's interesting in the short term, multifamily, which of course I agree with, has the best fundamentals, best prospects for continued demand. Demographics are great. Construction is expensive. Homes are less affordable. All that is absolutely true in the short term because they had the lowest cap rates, including some of the best credit. Single tenant, of course, had the lowest cap rates. The interest rate shock has delivered more of a problem in the short term than they have for a 7 cap office building or an 8 cap shopping center that somebody's buying to reposition. And so that's a short-term phenomenon, but we are seeing more disruption on the valuation of those very high, in demand, extremely low cap rate assets, as far as, how do you reprice them? And what happens to maturing loans on those? Remember, the debt funds accounted for a lot of that short-term debt in the last 3 years or so. Once we get through the mechanics of solving those problems, I think the market will normalize. But anyway, those are a few other perspectives I thought I'd share.
Thank you. We have a triple net question for Camille. Do you see the QSR triple net deals in 2023 to 24 with higher cap rates of 5.5 to 7.5%? And with the inflation rate being higher, should you only focus on triple net deals with rent escalations built into the lease?
Well, those are probably kind of 2 different questions. I think it does fundamentally depend on where underlying debt goes. I think the QSR space will continue to have, for the strongest credits, will continue to have very low cap rates, will be some of the lowest cap rates in the market. I'm going to be pretty shocked if it gets up to 7.5. I think that's probably, that is nothing that our teams would be underwriting to right now. Of course, depending on the credit and depending on the lease terms, and, you know, as I always like to joke, no two leases are created equally. So it sort of depends. As far as escalations go, I mean, I've never been shy about saying I am a strong believer in rent escalations. So I really, make sure you have rent escalations. That's a pretty straightforward answer. There's probably a space or an argument for not having that on a particular tenant or one-off property because the underlying lease term is shorter, or the equity growth potential of that particular parcel is so high, but it is an absolute exception, not the rule. You know, get escalations. I mean, I would say, you know, we sell a ton of pharmacies and like the pharmacy space. And I think, you know, as I mentioned, zero cash flows a minute ago, they do really well for solving lots of different 1031 exchange and net lease problems. But one of the criticisms that you can easily have a pharmacy, and one thing you need to be cautious about in terms of putting in your portfolio, is that there generally aren't rent escalations. So that's a bit of a problem. I would say most of your QSR assets, that's why I say those questions are a little bit different. You know, most of your QSR assets do have rent escalations, but again, all rent escalations are not created equally either. So are you getting 3% or CPI every year? Or are you getting 3% every 10 years? You know, I mean, those are both rent escalations, but they're not the same. So
We have a couple of questions about niche sectors, well, related niche sectors, life science and medical office. What do you see as the prospects in both of those and the opportunities in both of those? Whoever wants to take it.
We're seeing incredible demand for both of those. You were asking earlier about opportunities by product type. I was going to mention those two, as well as hospitality. Hospitality has what seems to be a limitless amount of buyer demand because it has, of course, recovered, you know, to a large extent, but there's more recovery to be had once we get past the next 12 months or so. But medical office and life sciences seem to also become the replacement of obsolete, you know, retail. There's a lot of healthcare related repositioning of obsolete shopping centers that seems to be happening, and we're seeing a lot of demand for it.
The demand for we do a lot of life sciences work. The growth has been explosive. It wasn't that many months even after the start of the pandemic when you knew you'd see reshoring, you'd see almost unlimited investments from both the public and the private sector to solve that problem and others. So it's all been great. San Diego, South San Francisco, Metro Boston has been huge, and then all the way down the Acela corridor to Metro DC. The growth is clearly flattening a little bit. It's still a good growth. And then I say the thing to watch about life sciences is you're wanting to see emerging clusters in many other places in the United States now. Houston is trying to get some things going, and they're making big investments. There's some things incubating here in Dallas, Chicago. RTP looks like a winner in the life sciences space for sure. Philly has really emerged. I think it'll still be a very, very healthy, productive specialty asset class, but the growth will slow.
Okay, so we are, sorry, was somebody else about to go?
I think I would agree that those healthcare related sectors are likely to hold up, and you'll see others as well.
Okay, great. So we're about to run out of time. I would like to go around all of you and just give you, ask you for your quick #1 prediction for 2023.
I'll start, I guess.
Okay.
I'd say challenge and opportunity, right? You know, for your existing portfolio, there's going to be continued challenges that you're going to need to work through, and we've talked about them, you know, in terms of debt and capital structure, and making sure you have the reserves to do that, to manage those challenges. But there's going to be a lot of opportunity too, coming out of the same things, right? Like, so as debt is maturing, and I think Chuck was talking about it earlier, right? There will be opportunity to step in, recapitalize some deals, and take advantage of those.
Yeah,
I-
sorry.
Jump in.
I think the need for liquidity is, and to have liquidity is just a top priority. I think that tenants who are low on cash are really going to be threatened, and investors who are low on cash are really going to be threatened. I think there's just going to be a limitation. So I think we're going to see over the next year, throughout next year, and maybe even in 2024, that challenge where there's just whether it's a public company or a startup or an investor, regional investors, if they don't have a substantial amount of liquidity, they're going to have challenges ahead of them.
I'll
I'll
jump in
jump-
next.
Oh, go ahead.
I would say that the Fed takes the foot off the gas by Q1, middle of Q1, not pivot to lower interest rates, but basically stops. And we see the job market go from positive job creation to some job losses, but moderate because there's so much demand for qualified workers. That will give the market enough clarity. There will be the corresponding price correction by that time for most assets and most situations. And we see trading really pick up in the back half of 2023.
Camille?
Well, I would say the minor prediction I had here was Q4, I bet, is huge next year. That I think I feel very solid about. I was going to say we're in a lot of discussions with groups pricing sale leaseback right now. That didn't really come up in our conversation, but Chuck was kind of alluding to it. I think he was probably alluding to more in a multi-tenant context, but I think corporate owners are looking for capital, and they're looking for capital partners, especially the ones that are in growth mode. And we're going to see a lot of sale leaseback, which our institutional owners have been dying for, just really haven't had nearly enough in the market. And it looks like now is the moment when that tide turns.
And John?
Yeah, I think look for opportunity in the second half. Commercial real estate continues to be probably the most underappreciated investment asset class there is out there. It is very stable on a relative basis. It feels a little unstable now, but over longer periods of time, and the performance is incredibly steady. I would sell crypto and buy commercial real estate, especially in the second half of the year.
Okay. On that note, unfortunately, we are out of time. We will be sending out a link when the recording's available, and we hope that you will join us for our next CPE webinar on December 8th, Winning Tenants with Smart Tech. If you didn't catch Oracle NetSuite's webinar on November 8th, you will find a link to that recording in the chat as well as on our website. And thank you again to Oracle NetSuite for sponsoring today's webinar. For more than 20 years, Oracle NetSuite has helped organizations grow, scale, and adapt to change. NetSuite provides a suite of cloud-based applications, which includes financials, enterprise resource planning, inventory management, HR, professional services automation, and omnichannel commerce, used by more than 32,000 customers in 200 countries and dependent territories. Thank you again to our speakers for today's very interesting discussion, and thank you all for joining us.
Thank you, Suzanne.
Thank you.
Suzanne.
Thanks for having us.
Well done.